We are living in a genuinely unprecedented era right now. Global sovereign debt is compounding at a velocity that frankly defies historical comparison. And if you look closely, the very foundation of our fiat currency system is showing some deep structural fractures. And sitting right at the center of the storm is gold. It is, without a doubt, the single most contradictory asset in the entire global financial system. Think about it. It pays absolutely zero interest. It generates zero cash flow. Warren Buffett famously dismissed it as a chicken that doesn't lay eggs. And yet, the second the global credit system starts to shake, what happens? It instantly reemerges as the ultimate, unyielding anchor of sovereign trust. So today, we're going to put on the hat of a senior macro analyst. We are going to thoroughly deconstruct the true underlying logic of how gold actually moves. We're stripping away the noisy headlines, we're cutting out the retail panic, and we're going to build a deep documentary-style analysis of the physical and macroeconomic laws that govern this incredible asset when the world goes into crisis mode. We have to start right away with a staggering paradox that completely caught the financial world off guard. Let's rewind to early 2026. A massive regional conflict erupts, directly threatening the Strait of Hormuz. Oil instantly spikes to $126 a barrel, and inflation immediately surges. Now, any traditional economics textbook will tell you that a safe haven asset should instinctively skyrocket in a terrifying scenario like that, right? And sure enough, traditional safe havens like US Treasuries and the Swiss franc saw frantic, massive inflows. But gold did the exact opposite. It plunged an astonishing 27%. It dropped all the way from over $5,500 down to $4,099. So you have to ask, why on earth did the ultimate safe haven seem to fail its very first real test? Well, as we're about to uncover, this wasn't a failure at all. What we actually witnessed was a hidden, highly predictable macroeconomic mechanism, a terrifying liquidity squeeze that repeats every single time a major systemic shock hits the system. So, to make sense of all this, we've got a packed roadmap today. We'll start with the war and crash paradox, move into the 4 crisis waves, then establish the physical hard bottom. After that, we'll dive into the fiat system game, unpack the institutional paradox, and finally, lock down some real-world strategic allocation. Section 1. The war and crash paradox. Okay, to solve this recent pricing mystery, we have to zoom out and look at the last 50 years of data. When we do that, a terrifying yet completely consistent historical pattern emerges. A gold crash during the onset of a major crisis is absolutely not an anomaly. It is a feature of the system. It's actually a vital lagging indicator before a massive asset repricing phase begins. Just look at the sheer panic of 1973 during the oil embargo. Gold initially dropped 29%, only to surge 117% just 15 months later. Or take 2008. As Lehman Brothers collapsed and the entire global financial system froze solid, gold plunged 33%. Going from $1,011 down to $681. Now, why does this happen? People weren't selling their gold because they suddenly lost faith in it. They were liquidating it because they were forced to. When margin calls hit during a crisis, institutions are desperate for cash, and gold is one of the very few pristine liquid assets they actually can sell. Every single time, this initial crisis creates a brutal, indiscriminate scramble for cash that pulls the metal down, right before the inevitable systemic response, fiat printing, sends it skyrocketing. Section 2. The 4 crisis waves. So how exactly does this extreme market environment transmit through the system? It happens in 5 highly methodical steps. First, you get the supply shock. Think of the sudden disruption of 20% of global oil going through the Strait of Hormuz. That violently pushes up costs and drags baseline inflation up to around 3.8%. Second, that sticky inflation forces central banks into a corner. They have to maintain or even raise their interest rate expectations. Third, and this is the critical breaking point, we hit the liquidity squeeze. Global institutions face a sudden, massive deficit of US dollars because they suddenly need them to pay for surging energy costs and desperate margin calls. And the mechanics of a margin call are ruthless. Institutions will dump whatever is liquid, including their gold, converting it to dollars just to survive the week. Fourth, the systemic pressure eventually becomes totally unbearable. With U.S. debt cresting $39 trillion, the credit system essentially breaks, forcing central banks into the only mathematical option they have left. They turn on the printing press. And finally, step 5. That newly printed fiat floods the system, triggering a massive global asset repricing. And what's fascinating is that this sequence forces us to look at how different assets actually queue up for this repricing. They do not move at the same time. The data from the 2008 crisis proves this beautifully. Gold bottomed first, way back in October. Why? Because it's highly liquid and widely held, so it absorbs that initial wave of panic selling, and then it catches the very first wave of fresh fiat printing. The S&P 500, on the other hand, didn't find its bottom until 5 whole months later in March of 2009. And real estate, being highly illiquid, it lagged even further, taking another 3 years to finally hit the floor in 2011 and 2012. For macro analysts, understanding this cue is absolutely paramount. Gold is the canary in the coal mine here. It bottoms first because the scramble for cash ends the exact moment the central banks surrender and start printing. Section 3. The physical hard bottom. Before we get too deep into the macro financial games, we have to ground our analysis in the inescapable physical laws of gold. Because this is what sets it apart from everything else. If you gathered all the gold ever mined in the entire history of humanity, roughly 210,000 tons, it would form a single cube measuring just 22 meters on each side. That's it. That sheer, unyielding scarcity dictates price against demand in a way nothing else does. You can't just hit a keystroke and digitally print 10,000 tons of physical gold. The process of exploring a new mine, securing environmental permits, running geological surveys, and deploying massive capital expenditure, it takes 10 to 15 years to extract the metal. The supply is completely stubbornly inelastic. So when we break down the demand, jewelry forms a solid cultural baseline at 45%, and private investment drives about 20% of the volatility. But it is the 15% of central bank buying, tightly combined with an absolutely crucial 8% from industrial demand, that creates a fiercely competitive, unbreakable physical price floor. And we really need to talk about that 8% industrial slice, because it is not optional. It is an absolute, non-negotiable baseline for human technological survival. Take the James Webb Space Telescope. It uses 100-nanometer thick gold mirrors. Why? Because gold's atomic structure absolutely refuses to oxidize in the harsh, corrosive vacuum of deep space, allowing it to perfectly reflect 98% of infrared light. Back on Earth, in micro-integrated circuits, gold is literally the only highly conductive material guaranteed not to corrode over decades. That ensures the neural networks powering modern AI function without catastrophic failure. In the medical field, nanogold particles are at the cutting edge, pioneering highly targeted cancer therapies. So think about this. Even if the entire world woke up tomorrow and decided to completely abandon the concept of fiat money, modern civilization literally cannot function without gold's unique physical properties. Section 4. The Fiat System Gang. Okay, expanding outward from those physical constraints, we step into the massive macro arena. This is the game being played by the smartest, most powerful money in the room. And right now, we are witnessing a massive, structural paradigm shift in how gold is valued. Historically, there was an ironclad rule. Gold maintained a negative 0.82 correlation with real interest rates. The logic was simple enough. If interest rates went up, gold went down, because holding a physical rock that pays no yield has an opportunity cost. But recently, we've seen an unprecedented decoupling that is blowing up the old models. Rates went up, the US dollar index strengthened significantly, and yet gold still surged alongside it. Why? Because the current strength of the dollar is largely a symptom of short-term liquidity panic, institutions desperately needing dollars just to buy oil and settle debts. But gold's strength? That is being driven by a profound long-term loss of faith in sovereign debt itself. The global fiat credit system is fundamentally fracturing, and the old textbook formulas are breaking down right before our eyes. And if you want the most glaring evidence of this fracturing credit system, just look at the silent, historic accumulation of physical gold by global central banks. They are quietly hoovering up well over 1,000 tons per year. The geopolitical motive here is overt, undeniable de-dollarization. When you look at the breakdown, the divide is incredibly stark. Western nations like the US, sitting on 8133 tons, and Germany with 3350 tons, maintain massive gold hoards that make up 60 to 80% of their total foreign reserves. Conversely, Eastern nations are aggressively accumulating massive absolute amounts. China now holds over 2,300 tons, and Russia is right there with them. Yet, for China, that massive pile represents a mere 4% of their total reserves. This exposes a massive, inevitable ceiling for future accumulation. These nations are systematically, relentlessly building sanctions-proof reserves that sit entirely outside the reach of the Western SWIFT banking system. To really visualize this bedrock of the system, imagine being deep beneath the bustling streets of Manhattan. Anchored 15 meters straight down into the solid granite bedrock sits the New York Federal Reserve Vault. Down there, sitting in the dark, is roughly 6,000 tons of gold. That is nearly 3% of all the gold humanity has ever mined. And the kicker? Most of it isn't even American. It's held in trust for 36 other sovereign nations. This vault is essentially the lingering ghost of the Bretton Woods system, a relic from a time when the US dollar was literally, legally, as good as gold, acting as the anchor for the entire post-World War II economy. Contrasting this physical, unhackable bedrock with today's reality of unbacked, infinitely printable fiat currency sharply illustrates exactly what these global central banks are hedging against. Section 5. The institutional paradox. So this brings us to a massive contradiction. If central banks, the architects of the monetary system, are accumulating gold at historic rates to hedge against a fiat collapse, why do mainstream financial asset managers intentionally avoid it? Well, put yourself in the shoes of a Wall Street portfolio manager reporting to an investment board. Modern finance is completely 100% reliant on yield and cash flow generation. Traditional valuation frameworks like discounted cash flow or dividend discount models work by dividing future earnings by a discount rate. But gold has zero cash flow. It doesn't pay a dividend. If you, as a manager, allocate billions to gold and the price drops, you face immense career risk. You look foolish for buying a non-yielding pet rock. But what if the price rises? Well, your clients immediately call you up and question why they are paying you a hefty 2% management fee just to sit on a static, inert commodity. For an institutional fund manager, heavily holding gold before a crisis becomes painfully obvious to the public is essentially professional suicide. And this dynamic creates a fascinating, highly volatile dichotomy in the market structure itself. On one side of the spectrum, you have massive, slow-moving central banks accumulating physical bars with an investment horizon of decades. But on the other side, because the big Wall Street institutions are mostly sitting on the sidelines, the daily market price is heavily influenced by retail investors and emotional speculative funds. These are people trading highly leveraged paper futures on phone apps. These retail traders chase headlines. They act on emotion, creating this massive 15 to 20% volatility noise that constantly distorts the rational pricing curve in the short term. They shake out the weak hands through panic selling at the worst possible times. Meanwhile, the smart institutional money patiently waits. They only step in after the liquidity crisis breaks the system and the massive fiat money printing is mathematically confirmed. Section 6. Strategic allocation. All right, so knowing the inescapable physics, the relentless central bank accumulation, and the institutional paradox, how does a macro analyst actually suggest deploying capital into this crazy environment? Well, the very first rule is understanding that not all gold exposure is created equal. You are choosing between entirely different asset classes with entirely different risk profiles. Physical gold, that provides direct, unhackable defense with absolute zero counterparty risk. But you have to pay secure storage costs. Gold ETFs, they provide amazing instantaneous liquidity, but they carry significant paper counterparty risk. I mean, what happens if the custodian actually goes bankrupt during a severe systemic collapse? Then you have gold miners. These offer massive leverage. If gold hits $4,700, a miner might pull $3,000 in pure profit on every single ounce. However, miners introduce massive company operational risks, jurisdictional nightmares, fluctuating diesel costs, strikes, and they are highly correlated to the broader equity markets. You absolutely must define your specific objective, leverage, liquidity, or pure defense before choosing your tool. The professional consensus for navigating this minefield relies on what's called the barbell strategy. Specifically, this means allocating a strict, mechanical 10 to 15% of your portfolio to gold, acting as a defensive anchor against your risk on assets. Now, why exactly 10 to 15%? Because mathematically, it is the absolute sweet spot. It provides enough torque to actually protect your overall portfolio during a severe fiat crash, but it's not so heavy that it drags down your overall yield during a protracted, multi-year bull market in equities. And the absolute key to executing this is mechanical dollar cost averaging. By buying fixed amounts at fixed, regular intervals, you entirely remove human emotion from the equation. You ignore that 15% retail volatility noise completely. You use time to average out your entry cost, and you use gold's physical scarcity to combat the mathematical long-term certainty of fiat currency debasement. Ultimately, the stark reality we are facing right now is driven by cold, hard mathematics, not sentiment. With the U.S. national debt cresting an incomprehensible $39 trillion and annual interest payments alone exceeding $1 trillion, the fiat system is backed into a dangerous corner. Printing money is no longer a political policy choice. It is an unavoidable mathematical inevitability. Gold is absolutely not a get-rich-quick investment scheme. It never has been. It is the financial bulletproof vest for a global credit system that is teetering on the brink of a major restructuring. The goal isn't to walk around wearing the vest over your entire body 24/7. The goal is to ensure you have that 10 to 15% firmly strapped on when the storm finally hits. So I leave you with this to think about. When the ultimate global fiat system reset occurs, will you be holding the ultimate physical anchor or a sinking paper ship? Keep analyzing the data, stay rational, and we'll catch you in the next explainer.